we have to be especially selective in our trade selection and in our strategy selection. It's just as important in a small account to be strategy conscious, trade conscious, allocation conscious, diversification conscious, all of those things, just as important as a big account, but there's less room for error and they're much more restrictive. So again, the odds a little bit stacked against you. So the more bullets we can arm, the more arms we can give you, the better off you'll be. That's what this is all about. As we discussed last week, the sale of out-of-the-money puts offer one way to effectively use capital for high probability trade. If you remember, in the Tasty Bites segment last week, we did a whole thing about out-of-the-money puts. Well, today we're going to continue the conversation with a useful trade known as a jade lizard, but you're going to see an interesting twist to this. Let's go to the next slide. A jade lizard is when you sell an out-of-the-money naked put and combine it with an out-of-the-money call spread. The premium collected, if the premium collected is more than the width of the strikes of the call spread, the trade only has risks to the downside. That makes it a very high probability trade because you could only lose in one direction. Again, you have defined profitability. Okay, and unlimited risk. So that doesn't change, but it's just adding the call spread to the naked short put to because you don't have to put up any more capital to do that.
That's the key.
And what it does is just to increase the size of the credit, making the trade even have a slightly higher, return on capital. You could do this in any type of account. Okay, let's go next slide. Skew builds extra premium into the out-of-the-money put and reduces the premium in the purchased out-of-the-money call. The jade lizard takes advantage of this by selling naked puts at a higher implied volatility and selling a call spread to take advantage of decreasing implied volatility on the call side. Again, we call this a skew trade, which means there's plenty of archives on Tasty Trade where you can learn about kind of volatility skew and pricing skew. But essentially what it means with respect to options is option puts are generally priced higher because of the downside risk, of the velocity of the downside, of what we call option skew. Ever since the crash of '87, the out-of-the-money puts have been priced higher than out-of-the-money calls. Because out-of-the-money calls, as you get further and further out of the way, and there's usually always calls for sale, out-of-the-money calls actually get cheaper. So out-of-the-money puts get more expensive, out-of-the-money calls actually get cheaper. So the call spread, which is the other side of the skew, call spreads are trade rich. I know it's going to sound weird, but call spreads trade rich, naked puts trade expensive. Put spreads trade cheap, and naked call put spreads trade cheap.
You got that right.
And naked calls trade cheap.
Correct. The put spreads trade cheap because of the implied volatility being higher on that lower priced put that you have to buy.
That's what skew is all about. So again, let me say this one more time. So the way skew works with respect to option pricing is puts trade expensive. Out-of-the-money puts generally trade expensive.
As in a loan trade.
Standalone trade. Out-of-the-money put spreads trade cheap. So let's sell out-of-the-money puts because that's the expensive one. Remember, we're always selling stuff that's expensive, buying stuff that's cheap. Out-of-the-money call spreads trade expensive because out-of-the-money calls trade cheap.
Correct.
All right? And I hope that makes sense. So what we're doing here is taking advantage of the skew by selling an out-of-the-money put and an out-of-the-money call spread. We're trying to collect enough premium to cover all the risk in one direction.
Which is always the upside.
And have the downside, that's where all our exposure is.
Correct.
Okay,
so it's a neutral to bullish strategy.
Let's go to the next slide. So take a look here because this is very interesting. We're going to put up an example of we went to, in this case, IBN. Remember that was that crazy stock we looked at that one time? It was like
Indian
$30.
Mm-hmm.
Some bank, right?
Yep.
Okay. We traded it one time. But just to give you an example of the skew, first start on the put side, which is the middle of the screen, right-hand side. Your left, my right. Tony's left.
If you're watching the internet and you're looking at us at home, it's on the left side.
You can see where the highlight
is. It's the same way you're looking at it. What do you think? We superimpose it for you to mess you up?
It's like a mirror.
Yeah.
The screen showing the 28 puts, which is highlighted, shows you that the 28 puts, the price is 24 cents. The implied
74 cents.
74 cents. The implied volatility is 49, and the percent out of the money is 71. Now, the reason that 49 is highlighted is because if you get closer to the money, it's only 44%. And if you get further away from the money to the 27 strike, it's 51%.
Showing you that the put spreads trade cheap.
That's put skew. Okay, that's what that is. Showing you that as you get closer to the money, the puts trade with a cheaper implied volatility. As you get further out of the money, the puts trade with a higher implied volatility. Remember what we always want to do. You want to sell high, buy low. That's selling high. On the call side, on the other side, you can see the calls, the at-the-money calls are priced higher than the out-of-the-money calls. As you get further out of the money and you go from the 31 to the 32 to the 33 to the 34, they get lower and lower and lower with respect to implied volatility. So out-of-the-money calls trade cheaper. Out-of-the-money puts trade more expensive. Out-of-the-money calls trade cheaper. This is a perfect example of volatility skew. Now look in the upper right-hand corner. If we sold the 28 put and the 33-34 call spread, we would collect $1.04. If you collect $1.04 and you're selling the 33-34 call spread, you have no risk to the upside. If you're collecting $1.04, your break even goes from 28 minus $1, which takes you down to 27.
Correct.
And then your statistical chance of not losing on this trade, not winning, but of not losing is 23%.
Very good.
I'm sorry. Inverse of that, 77%. Your statistical chance of not losing is you take the 27 line, the chances of it being out of the money is 77%. That's your statistical chance of not losing, 77%. We usually use in the money, but that's fine. So what's so interesting about this is all you're doing, again, as traders, all we're trying to do is, hey, how can you have a 77% chance of not losing? Well, it's easy because the most you can make is $1.
Correct.
And you have unlimited risk.
Correct.
So you're essentially saying, and by the way, unlimited risk can be defined as well. So let's not get carried away here. But
industry standards going to tell you that you have unlimited risk.
For all intents and purposes, you have defined profitability, 77% chance of success. Now, I ask you, like we ask a million times, if you're able to generate a situation where you have a 77% chance of success, and I know the most you can only make is $1, would you prefer that over unlimited profitability and a 23% chance? Because everybody that says that's dumb and I don't want to take unlimited risk, you can do the other side. The market is only 1 penny wide or 2 pennies wide. So if you don't like that side, you can do the other side. That's a beautiful thing. That's why I hate the argument which goes, well, this is dumb. Really? Because if it's dumb, that means the other side's smart. And if the other side's
be the smart side.
Then do the smart side. Right. Genius. See, a lot of people say this is dumb, and they have no idea what they're talking about, because if it's really dumb,
do the other side.
Do the other side, and don't tell anybody, because you know what? Then you like it. Shh. Because it's a gift. See, everybody who says this is really dumb doesn't have any idea what they're talking about, because they don't understand they can do the other side. Like here, let's just say this. The Bears play the Vikings this week, right?
Yes. Let's
say the Bears are 7 point. I don't know what the line is.
I didn't look.
Let's say they're 7 point favorites.
Okay.
They're probably about 5 or whatever. Let's say they're 7. The Bears are 7 point favorites.
What fan are you? They're probably 14-point favorites, but go ahead.
Let's say the Bears are 7 point favorites, okay? And you say to me, I'd like to take the Vikings even. That's what you say, okay? Mm-hmm. Now, I know the Bears are 7 point favorites. So I'm going to look around and go, oh, man, you're picking me off again. But done. Right? This is Tony Batiste. You're going to wind up, I want the Vikings at even. And I'll be like, yeah, Bat,
you're pretty good, though, at this football thing.
You're pretty good, man. You're never wrong. But you know what? I haven't even checked the line yet. Now, I know they're 7. I haven't even checked the line. You know what?
All right.
Take a fill. How much you want to do? And you're like, well, how much will you do? Just give me a number.
Right.
That's how we would be.
Sure.
Because
you can take the other side.
Sure, I'm taking the other side. I'm not going to tell you that it's a dumb bet.
Mm-hmm.
You think this is a dumb bet? Then do the other side and shut up. Right. If you don't do the other side, then you might not just like the trade because you have other things on. That's fine. But don't say it's dumb.
Correct.
Because it's not. Because if you think it's dumb, then do the other side. This is what I hate about all the...
Because then it should be a no-brainer.
Well, that's what I hate about all the naysayers in the business. They're all like, this is the dumbest thing ever. You take unlimited risk to make $1? Really? Then do the other side.
Right.
Just do the other side and shut up. Because it's a penny wide.
Right.
Let's put...
You'll be proving me wrong. You'll be proving yourself right.
Let's put this industry where it should be. It's not a question of... We're not taking you down some path where we're going to drop you off in the middle of the woods and leave you. We're not taking you to the farm. What do we have to gain? We're not taking you somewhere and leaving you there in the middle of nowhere in the forest and saying, fend for yourself.
You're it.
If you don't like the trade, then do the other side. It's a penny either way. That's the beautiful thing. Nobody ever says that about derivatives. Hey, if you don't like it, do the other side. I mean, I know I sound like a broken record, but it's so critical that you understand that there's another side that's only a penny away. So anyway, we like to collect the $1.04. We like to have limited profitability. We like the 77% chance success. And again, if you want unlimited profitability, take the 23% shot. Okay, but it's the same thing. It's a efficient marketplace. Let's go next slide. So in this example, we're selling the 71% out of the money naked put and the 33-34 call spread with the short strike, 69% out of the money. We take advantage of the volatility being higher on the put side and lower on the call side, increasing the credit received. The reason it's 69% here and not 73 is because I took the dollar and I added it to the short strike. Okay, and so I moved it down a strike for my break even. 69% is the chances of keeping the whole thing, or at least on the downside. 73% is the chance of staying above your break even. Let's go next slide. Because the credit of $1 is greater than the width of the $1 call spread, there's no risk to the upside. And our break even point to the downside is 26.96, which has a 23%, which is what we just explained. Let's go next slide. Now here's where we get cool. So we conducted a study to show the benefits of the Jade Lizard strategy. We used EWW, which is the Mexican index, right?
Correct.
And looked back for times when the IV percentile was over 50 for the past 5 years. Now, I've never seen anybody do this study before, but this is really cool, and this is going to put a lot more context around this discussion. So from this, we sold a call spread that gave us 1/3 the width of the strikes and a corresponding put, so the total credit received was equal to the width of the strikes, again giving us no upside risk. Again, this time we're doing it in EWW. We're selling a call spread that gave us 1/3 the width of the strikes and a corresponding put so that the total credit was equal to the width of the strikes. We're doing this so there's no risk to the upside, all downside risk. So watch this. With the P&L for the naked put, $436. The P&L for the call spread alone, $219. The call spread for the Jade Lizard, $654, which means that using this strategy and doing it when implied volatility exceeded 50%. And when was the study for? Was this 5 years?
5-year study.
5-year study. 5-year study. The number of instances over 5 years where the IV
was over 50%.
Was 12 times. The biggest loser was $348 on the Jade Lizard. The biggest and that was the biggest one-time loss. Mm-hmm. But the total amount received over 5 years was $654 with 11 out of 12 winners. And that's with, and remember, the statistical chance in most of these cases was going to be around 77%.
Correct.
Now listen, this is really critical, and I wish I could spend an hour on this.
It's actually greater, right?
Yeah, because nobody's ever done this before. Look at the naked put, look at the call spread, look at the Jade Lizard. This is using the same amount of capital.
Correct.
Once you do the naked put, it's using the same amount of capital. And the suggestion here is combining the two together. With implied volatility over 50%, the Jade Lizard is a great strategy. It's better than a naked put by itself, better than the call spread, whatever it is. Mm-hmm. And the winning percentage in most of these cases came out, the statistical chance up front came out to about 77, between 70, let's call it 75 and 80. The example we showed was 77. But the actual winning percentage was 91.
Again, now, just showing you that there's a little bit of extra juice.
Now, somebody emailed us yesterday and said, I need 88% to get over the break even with all the stuff you guys teach, blah, 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 blah. I understand. Here's a perfect example of how 78% over 5 years turns into 91% or almost 92%. It's a great example showing you that implied volatility and the measure of IV percentile and chances of being in the money, how rich implied volatility prices stuff. And as long as you don't get that 3 or 4 or 5 standard deviation move, which does happen occasionally,
sure.
How strong this methodology is and how important it is to sell as much crap as you can using the same amount of capital so that you can expand your capital use because you get rewarded for it. The Jade Lizard paid $654 and using the exact same amount of capital, okay, that you have on the naked put, paid $436. That's it, period. And you still had 11 out of 12 winners. And you still had virtually the same size drawdown.
Powerful stuff.
It's amazing stuff. And you know what? We missed it. We missed it. Damn it, we missed it.
We're catching up now, though.
I know. But we missed it during an unbelievable bull market run because we weren't paying attention to this. We were still trying to figure out what's XYZ going to do tomorrow.
Right.
We're still
what direction is it
we're
gonna
still
go?
Dummies when it comes to we're still trying to figure out what is the directional bet. What's XYZ going to do tomorrow? When all along it was staring us right in front of the face, slapping us in the face, and we didn't get you. We could see that a strategy we could see that as a strategy, the Jade Lizard, when executed during periods of high volatility, was a winner 91.67% of the time. Now, what's important about that is it was only supposed to be a winner about 77.5% of the time. So it had that big, huge jump in actual versus suggested. Okay, or actual versus implied, whatever you want to say. And then the next piece to it was just by using the same amount of capital, how much we increased our return from, just compared to a naked put, the Jade Lizard increased profitability from 436 to 654 and lowered losses while eliminating risk to the upside. Really interesting. Last slide. The Jade Lizard is an excellent strategy for a smaller size account when conditions are correct in periods of high implied volatility. It capitalizes on the natural volatility skew in the market. This lowers the break even to the downside while eliminating risk to the upside. This is an extremely powerful Tasty Bites, one of the best we've ever done.